Mortgage demand has dropped to a new 28-year low. New home listings are down nearly 17%, and home sales are down almost 30%. Homes are taking longer time to. Will the housing market crash in 2023? How does inflation affect the housing market? Stay tuned for today's video, which examines why the housing market will crash in 2023.
What a year.
The Federal Reserve Bank of the United States cuts interest rates near zero to stimulate the U.S. economy, devastated by the COVID-19 pandemic and the global disruptions it caused. The rate cuts pushed mortgage rates to historic lows, allowing prospective homebuyers to purchase homes with much lower credit. When combined with the mass migration of Americans who no longer had to live close to where they worked as remote working became more norm during the COVID-19 pandemic, house prices in the United States skyrocketed. However, the Fed began tightening monetary policy in 2022 with aggressive rate hikes to combat inflation, pushing mortgage rates to their highest level since 2002. Soon in the video, we will discuss the correlation between mortgage rates and Fed interest rates, so watch till the end.
I want to know more.
This increased the cost of home purchasing and drove many would-be buyers out of the market.
This is painful for a lot of people. Increased rates means homes are less affordable than they have been. Keep this in mind.
In response, many analysts, including Goldman Sachs, predict a housing market crash in 2023.
No, not my house.
Let us dive into the major factors that will lead to the potential housing market crash in 2023.
Great!
Number 4 on the list of the factors that can lead housing market crash in 2023 is overbuilding. When there are more homes for sale and under construction than potential buyers, home prices tend to fall because there's less demand and more supply. If developers build too many houses, or if people invest more in property development than people demand, this could lead to a housing market glut and a housing market crash. The construction of new homes has increased significantly over the last 2 years, resulting in the highest number of homes under construction since the 1970s. Approximately 1.6 million homes are currently under construction, which is 4 times the number seen in the housing market 10 years ago. Unsurprisingly, many people are more concerned about overbuilding as a cause of the potential 2023 housing market crash.
Get me the White House.
Number 3 on the list is the high inflation rate. When an economy's inflation rate rises, consumers are put under pressure. This is because the price of goods and services rise to the point where some consumers who could previously afford certain items need help to do so. When inflation rises, the prices of building materials rise, and home builders then pass the extra cost to consumers after building, making home ownership unaffordable for more prospective buyers. Furthermore, current homeowners face a difficult financial situation when inflation rates rise. As a result, defaults and foreclosures occur, increasing the market supply of homes and decreasing demand. Also during a recession, there is a high supply of housing than demand. Soon in the video, we will discuss this in detail and how it can lead to a housing market crash, so stay tuned.
All right.
We produce a data-driven analysis of the latest housing and stock market trends with projections based on facts. To avoid missing any of the videos, kindly subscribe to the channel and press the bell icon.
I subscribe to that.
According to the latest seasonally adjusted inflation figures released by the Bureau of Labor Statistics on February 14th, the CPI rose 0.5% in January 2023, compared to a 0.1% increase in December 2022 and a 0.2% increase in November of last year. The 12-month inflation rate increased by 6.4% between January 2022 and January 2023, compared to 6.5% between December 2021 and December 2022. This means that inflation rates will continue to rise, putting pressure on the housing market and causing a potential crash. Talking about inflation, let's then move to number 2, which is high mortgage interest rates since it is related to inflation. When the inflation rate becomes too high, the U.S. Federal Reserve Bank is forced to intervene in the market to reduce inflation. They accomplish this by aggressively raising interest rates, which continue to rise. When interest rates are high, taking out loans becomes more expensive, resulting in increased or rising mortgage interest rates and a decline in home ownership.
Just out of reach for more people, which makes me wonder how inflation is even connected to increased mortgage rates.
Well, let's take a look, because the Fed raises interest rates to combat high inflation like they're doing right now. And so when they raise interest rates, what they're really doing is adjusting the federal funds rate, or what banks charge each other to lend money. So when the federal funds rate goes up, so does the mortgage rate, right?
There we go.
It's all connected.
Mortgage rates have reached record highs and may rise even further as the Federal Reserve Bank works to keep inflation under control.
Keep everything under control. Yes, sir.
According to bank rate data, the current 30-year fixed mortgage interest rate is at 7.02%, up 19 basis points from the same time last 7 days, and the average 15-year fixed refinance rate is at 6.38%, an increase of 12 basis points over the previous 7 days. On Monday, February 27, 2023, the current average interest rate for the benchmark 30-year fixed mortgage is 7.02%, up 19 basis points since the same time last week. Financial market participants expect the Fed to raise its target Fed funds rate by 175 to 200 basis points from current levels as inflation rises in 2023. This will result in 30-year and 15-year mortgage rates averaging 8.50% and 7.70% respectively. This means that there will be a high supply of houses with less demand, since the affordability of mortgages is not there.
Now I need a house.
The number one on the list is the occurrence of a recession in 2023, as seen in the 2008 Great Recession. The 2023 recession that financial market participants and experts are projecting could lead to a potential housing market crash in 2023. Recessions are defined as a decline in economic activity and can significantly impact the housing market and the economy as a whole. Because when there is a recession, many people lose their jobs or have their working hours reduced, making it difficult for them to eat properly, let alone afford a home, since households are put under pressure.
But, recessions are just really not good, right? Because a lot of people are suffering financially in a very significant way, particularly lower middle income households who, don't have a lot of cash cushion and financial resources. They're going to be under a lot of pressure here.
Furthermore, when the economy slumps, people may be more hesitant to make large financial investments, such as purchasing a home, resulting in a higher housing supply with lower demand for them.
Is it chumbo?
Last year, the World Bank said a global recession is likely to occur in 2023.
The world's three largest economies, the US, China, and the Euro area, have been slowing down sharply, and even a moderate hit to the global economy over the next year could tip it into recession, is what the bank has said in a new study. Not just that, the global institution also said that the global economy was now in its steepest slowdown following a post-recession recovery since 1970, and consumer confidence had already dropped more sharply than in the run-up to the previous global recessions.
Even though there is no release from the National Bureau of Economic Research declaring a recession in the United States, many market participants believe one will occur in 2023. And if this occurs, the financial market will crash, leading to the housing market crash as seen in the 2008 market crisis. In conclusion, there is a possibility that the housing market will crash in 2023, but this is not certain as market conditions change all the time. This said, put your eyes on the factors stated since their simultaneous occurrence could lead to the housing market crash.